Good morning and welcome to the webinar hosted by CFA Institute and IRC Institute, Environmental, Social, and Governance Survey. Our agenda today is welcome and logistics, introductions, an in-depth review of the survey results, and a few words from the IRC Institute on their perspective on the survey. Following that, we'll take your questions. The logistics for the webinar today: all of the attendees are in listen-only mode, but we do encourage your questions. In your control panel, you'll see a question box. Throughout the webinar, you can type your questions into the function box. After the presenters have delivered their remarks, we'll respond to your questions by reading them aloud. You can find the survey at the CFA Institute website, www.cfainstitute.org. We also encourage you to share these survey results on social media. The Twitter handles are at CFA Institute and at IRC Research. A replay of this webinar will be available along with this PowerPoint presentation. Just watch for an email that probably will come tomorrow with a link to a replay as well as a link to download this PowerPoint presentation. If you should have any technical issues during the webinar, don't hesitate to call GoToMeeting at 1-800-263-6317. Our speakers today are Matt Orsa, he's the Director of Capital Markets at CFA Institute. Matt spearheaded this survey along with the team at CFA Institute. Also on the call today is John Lekumnik, Executive Director of the IRC Institute. Just a few words on the IRC Institute if you're not familiar with the organization. It's a nonprofit that was established in 2005. What the Institute does is it funds and disseminates research on a broad range of issues of interest to investors. It's at the intersection of corporate responsibility and the informational needs of investors. We also sponsor an annual research award, and all of the research published by the IRC Institute is available at no charge on the website. Just to give you an idea of the scope of research developed by the IRC Institute, everything from ESG issues to human capital issues, high-frequency trading, cybersecurity, executive compensation. So just take a peek at some of that research if any of it is of interest to you. And with that, I'll turn the presentation over to Matt to talk about the CFA Institute and to run through the survey findings in detail for you. Matt?
Thanks, Kelly, and thanks everybody for joining us this morning. As I was said, my name is Matt Orsa. I'm Director of Capital Markets at CFA Institute. And for those who don't know, CFA Institute is, you may know us as those people who give those diabolical exams to get your Chartered Financial Analyst designation. I had to get one too, but I'm not part of the group that gives the exam. I'm part of the advocacy or think tank arm of CFA Institute, and that's where this survey came from. We're an organization of about 130,000 members worldwide. Financial professionals who have got their Chartered Financial Analyst designation. Next slide. And I want to talk a little about where we came in ESG and what we're looking at CFA Institute as far as ESG is going. I got my charter in 2003. Took my last exam in 2003, and I believe it was 2004, 2005 when corporate governance issues started making their way into the curriculum. In 2008 or 2009, I believe, the E and the S of ESG made its way into the curriculum, and now there's ESG readings at every level of the CFA curriculum, levels 1, 2, and 3. Around 160,000 people sat for the exam the first weekend of June globally. Of the CFA exam. There's also level 1 exam given in December, and with those numbers, it's about 200,000 a year. But some of those are repeats because people might take level 1 in December and level 2 in June or something like that. But you can see that from this now and going forward, there's 160,000 and growing people who take these exams, learning how to be financial professionals around the world, and ESG is one of the things that they take for granted that they have to learn to be a financial professional and get their charter. A little bit of what we've done in ESG, we put out an ESG manual in 2008, kind of ESG 101 for our members and investors. We're updating that, in the process of updating that now. That should come out in October, November We have an ESG page of our website that focuses on ESG issues, and it'll give you all the information you need. It's ESG 100 is kind of a self quiz about how to understand ESG issues. And we're actively involved in speaking around environmental, social, and governance issues. And our societies are as well. I just highlight here some of the larger societies we have. That some of them have either ESG committees or sustainability committees, but they host a number of events, whether they're governance events, environmental, social, and governance events, or what have you, in ESG every year. And now, getting into the survey, this first slide we asked simply, which, if any, of the following ESG issues do you take into account, in your investment decision making? Oh, I'm sorry, I skipped ahead a slide. Just a little about the survey. The survey was put out on the 26th of May, and was out for about a week and a half, 2 weeks. And our membership, our membership was surveyed. Again, we have about 130,000 folks worldwide. We asked those who are analysts and fund managers, and that population was about 45,000 or around their opinions on ESG issues, and we got about a 3% response rate globally. And now onto the slides. I got a little bit ahead of myself. We asked, first of all, which, if any, of the following ESG issues do you take into account in the investment decision-making process? We found that about 73% said that they take ESG into consideration in some form or another. Now, you don't see 73 on the slide below, but if you look at the last section of bars there, I don't take ESG factors into consideration. 100 minus 27, you don't, is 73. And then you can break down, a lot of these slides will follow this format. We'll have the total, what those in the Americas said, what those in Asia Pacific said, what those in Europe, Middle East, and Africa said. And then we broke it down to institutional and private. Our members who are managing money for institutional firms or analysts focus in institutional, work for institutional firms or private firms. And so don't worry about following everything on the slide. As was said before, this whole slide deck is on the CFA Institute website. So try to absorb it now, and if you need any more detail, go to our website or feel free to get in touch with us after the slideshow. Then we asked, why do people take ESG issues into consideration in their investment decision-making process? Way back when, people might have thought that it was mostly that they thought of ESG as a negative screening tool, and a lot of folks still think of it outside of the ESG community may still think of it as that. But for the most part, the way we frame it in the curriculum and the way it's done in practice is to help manage investment risk. And I would add to that, looking for opportunities as well. It's a risk or opportunity calculus is what people are looking at when they're starting to look at ESG issues. Second most answered was clients demand it, and then after that it was seen as a kind of a proxy for quality management. And then how do you take ESG issues into consideration? Most people do full integration of ESG into their investment process, and you can see that exclusionary screening that I talked about is kind of third place. That's what people used to think ESG investing was all about, just getting rid of sin stocks, for example, tobacco and firearms, whatever, what have you. But we see most people now who are doing ESG in some form or another are doing it by integrating ESG into the investment process. And then after that, looking at kind of best-in-class positive screening. And then we asked, how do people get ESG information? How do they get data? This is one of the complaints we've heard over the years of one reason people don't integrate ESG into their investment process is the data simply isn't there. So we were curious, where do people get their data? And for the most part, it's public information. And then you can find this on the web or on your Bloomberg terminal, what have you. And then second is third-party specialty research that's really boomed in the last couple of years. That again, 5-10 years ago, there wasn't much out there. But as the demand for ESG information has grown, so has the supply of third-party research. Interestingly enough, the third most used source is reports and statements from the companies themselves. Most large companies now have sustainability reports, ESG reports, but we see this slide is kind of showing us that there's a trust but verify dynamic going on here, where investors and analysts like the information they're getting from companies, but then they want to go out and find more on their own. And then we asked people what were the most important ESG issues to them, and you can see, some of these, people could add people. The way we got to the slide was we asked people their top 5 most important issues, and then aggregated the top. If something finished in the top 2, it appears in the slide. So you can see board accountability was almost 80% of the time. It was in the top 2 people's biggest concerns as far as ESG issues go, followed by human capital and executive compensation. And we don't really get into an environmental issue until the 4th, which gets into just over 54%. Environmental degradation was one of the most important things they look at with ESG issues, which gets back to into kind of debunking the myths of ESG and the perceptions of ESG. A lot of people just hear the acronym ESG and they think, well, that's about environmental issues or environmentalism. That's part of it, but there's a lot more going on here. And you see, remember back to that 27% in the first slide, we talked about 27% who said they don't take ESG issues into consideration. The most who said they don't take ESG issues into consideration said they do so because there's a lack of demand from investors, followed by they don't think the issue or issues are material. So you'll see, in EMEA and in APAC, for instance, there's a lot more uptake of ESG integration into the investment process, and in the Americas there isn't as much. I think a lot of that is there isn't the demand when you're looking at investors, institutional investors in Europe. This is in PDFs they send out that the managers have to take this stuff into consideration, and in the U.S., especially in the U.S., and that isn't the case as much. It'll be interesting to see, if we do this survey 3-5 years down the road, how that changes. But again, it's a supply and demand question where the demand isn't where the demand is the issue that's mostly driving why people don't integrate this into their investment process. And that has changed over the years, and it will be interesting to see how that trend continues and where it goes in the future. And we asked, do employees at your firm receive training and how they consider ESG issues? You see there's still very little formalized training around ESG issues. Those of us in the governance and ESG communities have seen in the past couple of years a lot of different offerings spring up about ESG education, talk of ESG certifications. But again, you'll see that not a lot of folks have formal training in this. You'll see if you go to the next slide, you'll see if they get that training. Where do they get that training? And it's not until the third most used option is live and personal instructional training courses. But it's interesting that you look at EMEA, and nearly half of the folks who are fund managers and analysts there receive some kind of training on ESG issues. But still, it's usually miscellaneous sources. And this is something that I would again expect to evolve over time. And again, if we do this survey the same way in a couple of years, I'd expect this to change some. But a lot of the training around ESG is very formalized now. And we asked, do you agree or disagree that public companies should be required to report some kind of ESG sustainability indicators, if you will? And most people agreed. I was a bit surprised this was as strong as it was. You can see, especially again in EMEA and APAC, there's more of a belief that there should be requirements of sustainability reporting, whatever that may be. And then finally, we got into kind of some assurance questions. It's just interesting to see the evolution of ESG reporting. Back 10 years ago, it was a bit of a surprise to see an ESG or a sustainability report. Usually only large companies were doing them. And now we're getting to the point where investors are looking for verification. They're not as content to just have the information. They want to make sure that information is accurate. And so we asked, do you think it's important that ESG disclosures be subject to verification? And again, you can see it's overwhelming that the answer is yes. And who do you think is best positioned to provide that? There's a little more split here. But most people would go with professional service firms that are specialized in ESG matters, ESG analysis. And again, think of the space, there wasn't much in this space 10 years ago. And then second, independent professional service firms, think the big four accountants who are also, doing some assurance in this area as well. And then we asked, what level of independent verification do you think is necessary? And this was almost split down the middle between, very limited, low level of verification or something similar to an audit that goes, deeper into the numbers. So it'll be very interesting to see how that shakes out in the future. If people are content with a low level of verification that they feel gets them far enough, or if they want something more. And then finally, the last question we asked about, what represents about how much you would be willing to pay for this kind of assurance of ESG data. And you can see there's no real consensus here. 18, 21, 16%, goes from about 10% of pay about 10% of the audit to about half of what is paid for the audit. So that, and again, that's in early days, so it's interesting to see how that will shake out. But most folks think from about 10% to a quarter, or almost most. That's about 40%. Think of, if you add together the 21 and the 16. Think that about somewhere around 10% to 25% of the audit cost would be what feels about right for the auditing of ESG information. And again, we'll see where that evolves. But that's it for me. I will now turn things over to our partner at IRCI, John McCumming.
Thanks, Matt. Thanks very much. I want to delve down for a second into that last set of slides because it is the emerging topic. And I know that the headlines of how many investors look at ESG issues will get the headlines. But I think that this is indicative of the quality of the survey, is that we get into some nuance, which is, should it be assured? And as Matt said, basically, it's if a corporation reports it, verify it. 69% of the respondents want independent assurance. There is, however, as Matt said, little agreement on what that means. And there's even some internal inconsistencies. So 51% would want use of an independent ESG firm as opposed to a CPA firm, for instance. But virtually an equal number of respondents want a high level of verification as those who would accept a more limited assurance, 44 to 46%. And I think that that's one of the advantages of this survey, is it's going to serve as a benchmark over time as to how this field evolves. And so we really shouldn't be surprised by the nuance and some internal inconsistencies. It's the real world. This is a survey of investors who have to deal with real world issues and competing equities and balance risk and reward and cost and opportunity at all times. And so there is going to be a marketplace of ideas of how much assurance is worth, how much they will take ESG into account. You're not going to have an all advocate or all opponent world looking at investors. And if you go to the next slide, I think that's the importance of this. It is a CFA Institute study. It is investor focused. It is not going to be dominated by a narrative of proponents or opponents. It is going to, it shows, and it, I think shows clearly an emergence of an overall trend, and then an emergence of some newer issues, such as the question of assurance. I think it's great data. I want to thank Matt. I want to thank the entire CFA Institute for doing it. It's great data. As Matt said, it does explode many of the old line myths of how it's used. And so here are the new truths rather than the old myths. ESG works clearly in conjunction with traditional financial analysts. It's a lens to look at different information and to look at risk and opportunities from systemic factors and to judge how an individual corporation deals with those types of risks and those types of opportunities. And it allows you to look at different information. And institutional investors, and I've been one for 30 years, are nothing if not information junkies. So this is a way to get information, to systematize information, and to look at it in conjunction with traditional financial information to get an overall sense of how companies are dealing with this set of challenges. And as in all challenges, it's all about risk and opportunity, and that is the classic investment decision. So this is just extending the type of analysis that CFA charter holders are known for to a different set of dimensions. And by extension, all investors look at it in terms of a different set of dimensions. With that, Kelly, I'll turn it back over to you. We'll take questions. I'm sure there are a lot because I know there are a lot of people on the line. So it's all over to you.
Sure. Thanks, everyone. So we're going to move on to the Q&A portion of the webinar. So just as a reminder, if you have questions, there's a question box in your control panel. Just type your question in there. I'll read it aloud, and John and or Matt can take a crack at responding to it. So I'll give everyone just a couple minutes to type in any questions you might have. It looks like we do have a couple questions already. The first one, why the disparity in the use of ESG in the Americas versus EMEA and APAC?
Matt, you want to take that, or you want me to take a crack at it?
I'll take a crack at it. I think historically EMEA has been ahead of the rest of the world integrating environmental, social, especially environmental, social, but all of ESG into the investment process. As I think I mentioned earlier, you'll talk to institutional investors, and it's in the RFPs they send out to managers, and that's less the case in North America. Maybe more in Canada than in the U.S., but it's still lagging behind a little in EMEA. And in APAC, I think what we saw from the survey was there's a stronger tilt towards using governance information because the governance standards of a lot of Asian markets there's a wide disparity. If you're investing in that side of the world, you go from Australia, which is seen kind of as one of the best in class globally, to some other markets they're seen as laggards in corporate governance. So investors see that there is a great disparity in corporate governance in Asia, and they see opportunity there. So if they can identify players with strong corporate governance in a market that's not known for corporate governance, that's a differentiating factor for them. And I think in Asia there's more tilt towards governance. And we looked at the 27% of folks, going back to the slides now, who said that they don't integrate ESG. 47%, we asked them, okay, why not? 47% of those, so nearly half, said there's not the demand from the clients. I think that's where it starts. Second, I think a distant second was that there's not the belief that ESG, whatever they're talking about, drives value. But about half said that there's not the demand there. And I think that's really where it's coming from. And I think that demand is growing. I said a couple times during the presentation that it'll be interesting to see how these trends of these answers change. I wish in a way we had done this survey 5 years ago, because we know a lot of these things, perceptions, and how ESG is used has changed. And I would think that will change as well. Look at the UNPRI. I forget the numbers, but it would, when they first started out, I think in 2006, so it's been around almost a decade. It's grown almost tenfold the amount of assets under management, if I remember correctly. I think it was like $6 trillion to begin with, and now it's in the 40s that have signed on to the UNPRI. Look at the information that just Bloomberg, for example, gives out, supplies their folks who are subscribers to Bloomberg. They talked to us, I think, 7 or 8 years ago when they first started ESG, putting ESG information on their terminals, and there was barely any there. And now there's tons of ESG information on Bloomberg, and it's something that there is a demand there because Bloomberg isn't a not-for-profit organization. They're giving that information out to their members, their clients, because their clients demand it, and that's growing. So I see the demand growing, and I would imagine that those numbers will change over time.
I would add just a couple of things about the dispersion between EMEA, APAC, and the U.S. Following the Asian crisis, there was a broad spread regional reaction that focused on governance, and it became ingrained, if you will, in the investment culture in some of the Asian countries. I also had the opportunity to work in some of the Asian countries for the IFC. There is a sense of long-term family-owned companies, and so they tend to think about some of these issues in an ownership stewardship sense, whereas there is still, to some extent in the United States, a trading mentality. So I think there's a time frame issue as well. Also, the regulatory regimes, and you could have a chicken or the egg argument as to which comes first, the regulatory regimes or the cultural issue in the area. But just as an indication of the differences, the regulatory regimes outside the Americas, and I know we're talking about the United States, and that does dominate the responses from the Americas. The regulatory regimes tend to give more weight to these issues. So, for instance, you have to produce an integrated report including sustainability issues to be listed on the Johannesburg Stock Exchange. In the UK, investment managers have to report on their stewardship and engagement activities with their portfolio companies. So there is clearly a cultural shift. Whether it is widening or lessening, we'll know the next time the CFA Institute does its research, but whoever pointed that out is correct. There is some, but on the other hand, you can still say it's 51%, the majority, barely, but a majority in the Americas do think these issues are important.
Our next question, why does there seem to be a disconnect between the survey and actual proxy voting results? Either one of you want to take that one?
I guess I would ask for clarification on the question, but not having that, I would venture to say that I think taking something into consideration and then having it rise to the level of it being an issue you're going to vote yes or no on the proxy, there could be a great chasm there. Just taking issues into consideration, the way we look at things is, and it can be said many different ways, is ESG factors, ESG issues are just part of the whole story of a corporation. If you're an investor, you're doing yourself a disservice if you don't understand the whole story. There are risks, there are opportunities in certain industries that can be found, in those ESG issues that to see the whole picture, know the whole story, you have to take into consideration. That's just a holistic view of how to incorporate everything into the investment process, fundamental analysis and ESG analysis. Whether something rises to a point where you're going to vote no on it as an investor, for many institutional investors, that's a long process that has to rise to a certain level before they may vote no on something.
I would also add that I would love clarification on the question too, and whoever has it can email and we'll get back to you one-on-one. But we had EY do a study for the IRC Institute last year, and it is up at ircinstitute.org. You can access that like all our research free of charge. But we looked at the growth of environmental and social resolutions. And in fact, the vote totals have been steadily increasing over years, both on an absolute number and when you disaggregate into the number of votes that get majority votes. There is also an increasing trend, and we have two other studies there on engagement also available at ircinstitute.org, which says engagement is increasing. So I don't want to say I disagree with the premise of the question, because the questioner may have been intended something else, but you see a clear growth in voting and a number of resolutions and on vote on resolutions on environmental and social proposals, and including governance, which is driving much of the engagement around say on pay, in particular in the United States, and I should say these were U.S. surveys and U.S. reports, you do see an increase there. So I'm not sure I agree with the premise of the question. But again, maybe the questioner had something different in mind.
Our next question, was there a breakdown by sector?
We do not do a breakdown by sector. I'm guessing sector of are they looking for ESG information in certain sectors? We do not do a breakdown by sector. We just ask our membership in general what do they look at. One thing to note is we didn't only ask folks who manage equity. That's a thing that I think a lot of times people just look at ESG issues as an equity issue. But many of the folks who answer this are in the bond world, and so they're looking at the world what's developing in green bonds, and do they evaluate ESG issues and looking at the creditworthiness of certain companies. So I would say we didn't break it down by sector, but it's across all investment professionals who are money managers or analysts who are CFAs, and that's a broad group.
The next question, if you want to look at slide 15, Matt, were examples given of public information, since this was distinct from company disclosed data, like the news media, for example?
Yeah, public information would be different than a regulatory filing. So it's not something that the company gives, but it's something that it's the broadest category. It's everything else that's not specialized third-party research that they paid for. It's not a report from the company. It's not engaging with the company. It may be a report out there on a whole industry by a group that is looking at water and water scarcity, but it's not provided by the company, and it's not specialized research that they commissioned. But it may be broad research such as that.
The next question, with respect to verification of ESG data, was internal audit not offered as an option? It seems like the obvious answer.
No, it wasn't offered as an option. What we're looking for is external verification. Was the question we were asking. I would guess that a lot of these firms that are getting external verification also have internal verification, but investors, want that independent third party for verification.
Internal audit is not usually available to external sources. So that's, I imagine, why CFA Institute didn't include it. I will tell you that we recently did more of an anecdotal study with the conference board about sustainable product and service development by the Global 100, and virtually every one of the companies there that would label a set of products or services either had IA or an external service provider. And you're correct, the companies themselves often use IA, but that information is not necessarily available to external investors.
That's right.
The next question is environmental impact assessment a must in your country? Here in Tanzania, assessment is a must, particularly for property developed near water resources. Anyone want to take that one?
I'll take it. A jurisdiction by jurisdiction analysis of regulation was not included in the CFA Institute. There clearly are environmental rules and regulations in every jurisdiction, and some of those regulatory filings would include them. So, for instance, the company filings in the United States and most of the major jurisdictions of which I know have to have a disclosure of any regulatory issues, lawsuits that are likely to be settled. Environmental reserves are a key accounting metric, both under U.S. GAAP and IAS and International Accounting Standards. So yes, there are a number of regulatory disclosures which would be subsumed into the where do you get information from, but they were not looked at on a jurisdiction by jurisdiction basis. They were looked at on a where do investors get information from, and the jurisdiction would require the company listed in that jurisdiction to disclose either in a public filing or in a bond risk identification, bond indenture.
The next question, the survey response rate was 3%. How does that compare with other CFA survey response rates?
That's about what we expect, and that's about what we get. We're happy with talking to our survey team who does this, who does this all year round for all kinds of different surveys. About 3 to 5% is considered a good gauge of sentiment about what they expect.
The next question, what individual factors within the ESG spectrum seem to be the most important or most utilized within the Americas?
Going back to the slide talking about what factors are most important to you, board accountability was, I forget exactly how it was phrased. Bear with me while I go back.
What slide was that, Matt? I'll pull the slide up. Right here?
Yeah, board accountability, slide 16. Yeah. In the U.S., looking at breaking it down, U.S. or Americas, but that's dominated by the U.S. Americas, EMEA, and APAC. In the U.S., there tends to be more buy-in on the G in ESG, and so governance issues tend to be more important to those in the Americas. And board accountability and executive comp, I believe, I'd have to go back and look, but I believe those were the top two that were looked at in the Americas. But the list doesn't change much from what you see here. Human capital was right up there as well.
Okay, our next question, what types of standards will evolve for what is ESG investing? Do you think standards are necessary for ESG to be integrated more broadly across the investment community? Why or why not?
I think standards are important. You look at things like GRI that's been around for a while. You look at what the SASB is doing, trying to working with companies and investors to try to identify what metrics are most important to companies and investors, and focus on those on a sector-by-sector basis. Those are the kind of standards that will help give people easier tools to use ESG information, ESG factors in their investment process. For example, one of the complaints you would hear is that, well, look, there's just not all these metrics are important. There's not you can't look at 200 metrics for my company and say they're all equally important. And that's something that the SASB, for example, the Sustainable Accounting Standards Board, is doing, trying to identify, okay, in the oil and gas industry, what are the half a dozen to a dozen metrics that really matter, really drive value and risk and opportunity, and in the software industry, and then the automotive industry, and so on. And that's helpful to boil down, okay, there's been agreement between investors and the analysts and the companies themselves that in the automotive industry, these are kind of the factors that matter more. So an investor can use that instead of just getting 200 metrics thrown at them and then trying to filter out what's important. So those kind of standards help, but I think it's largely a cultural shift, a cultural change that's happening of incorporating ESG into the investment process, and cultural changes take time. Think back 10 years ago, going through the slide deck, a lot of the firms that verified ESG information weren't around. A lot of companies weren't giving out ESG reports. Bloomberg wasn't carrying this data. The SASB wasn't around. The UNPRI hadn't started yet. That started in 2006. And so there's been a cultural shift for more demand of ESG information, understanding that ESG information can help drive value and identify opportunities and help mitigate risks over the long term. And I would imagine over time that becomes just ingrained and part of the investment process. We put it in our curriculum as one of many, many things that a candidate who's trying to get their CFA charter has to know. I tell people, look, there's 50 different things. I haven't counted them, but there's 50 different things you have to study in the CFA curriculum, from bond valuation to stock valuation to portfolio management to statistics and on and on and on. And ESG is one of those. So it is being folded into what it means to be a good analyst or good fund manager. And maybe 10, 15 years from now, it's not called ESG. It's just called analysis. It's just accepted and folded into analysis, that it's taken for granted that it's there. Then it's part of what it means to be a good analyst or fund manager. So I think the standards help get us there, but I think it's just a cultural change that happens over time. And you'll see the demand has grown over time. And if we do this, as I said, if we do the survey down 5 years down the line, has that demand line gone up? I would expect it would, but we'll have to wait and see.
Our next question, do you know if there have been previous surveys of similar populations on this topic? And if so, how did the results differ?
Not to my knowledge. That's one of the things that we thought was interesting. An interesting thing we could offer about this survey. We're in the process, I said, of updating our ESG manual, and a lot of these answers are going to be incorporated into that when it comes out in a couple months. We wanted to know what practitioners who are out there in the field every day are thinking and using ESG for, but we hadn't seen that anywhere else.
Our next question, do you think there's a chance the data was positively skewed by respondents who were more inclined towards interest in ESG? In other words, is it possible that many people who are not interested in ESG just didn't respond to the survey?
We asked our in-house survey team about that, and they said that they've done surveys in the past where it's a similar issue, where there may be a population that gravitates towards that issue or doesn't gravitate towards that issue. And they do testing to see if that is the case, and they usually find that it doesn't change things much because of the large population. The population of our survey was so large that the ESG community that focuses mainly just on ESG issues is so small compared to the broader survey population that they wouldn't have the population needed, the numbers needed to skew the data very much. And another way to look at that is that I'd have to go back and look at the numbers, but I think about 60% of the survey respondents came from the Americas, just because our population is biggest in the U.S. and Canada relative to other markets. And if you look at the totals, you'll see that the U.S. The Americas numbers skew the totals a little bit compared to what EMEA and APAC have. And the Americas are the most skeptical about using ESG information. So I think that's a good control to look at to see, okay, what is the total? Because the Americas numbers are pulling that down a little bit. So I think the total is a good gauge if you're worried about skewing by ESG folks answering the survey. Well, the total should give you a pretty good judge of where things are globally.
Our next question, we have quite a few questions in the queue, so I'll just keep going through them. Climate change was surprisingly low down the list of top ESG issues. Is that discouraging from your perspective? I would have thought that respondents that understand ESG issues would have ranked climate change much higher up the list of importance.
No, that's not surprising to me. There's a diverse number of, in the governance world, in the social world, and environmental world, a diverse number of ESG issues out there, and I think I think that maybe that proves that there isn't much of a skew to the survey, because I would guess that folks in the ESG community who do this every day, that would be very high on their list. But for most of our members, it's probably a governance issue that might come first. So it doesn't surprise me. I would think that your average population of investors around the world, that's probably not a top issue, probably rising, but probably not a top issue. And for those in the ESG community itself, I would guess it would be a much higher issue.
I also want to add two things about that. 40% said climate change, a larger percentage said environmental degradation. That is still a relatively high percentage, right? I mean, it's not like it didn't make the top list. So, we sometimes talk about absolute return or relative return. I don't think, let's look at these in terms of absolutes, not relatives to some extent. But the second thing is, I think that's one of the advantages of this survey is I do a lot of work with people who are concerned about executive compensation, or people who are concerned about the environment, or people who are concerned about high performance workplace practices. And each group tends to focus on its issue, all of which obviously are important to investors across the board. But this is a survey of investors and analysts and portfolio managers and other CFA members. And I think what you're seeing is that all of them have some absolute level of import to the CFA members. And we tend often to be in our own little silos and focus on it. I mean, just as an example, personally, I spent a bunch of time the last 2 weeks doing an online climate change think tank. And believe me, if you surveyed that group of people, climate change would have been number one. But I also spent much of last fall dealing with some executive compensation and links to economic profitability issues. And if you surveyed the people who were involved in that, it would have been executive compensation. The value of this is it's investors across the board. It is not advocates for one or the other. And so the fact that the CFA charter holders think that all of these have import to analyzing the risks and opportunities in the markets, I think it is really what sets this apart, as opposed to a single set of issues that, however important they are talking to previously ordained activists in those issues.
The next question's maybe somewhat related. Was there any parsing of E versus S versus G in the survey?
No, I mean there was a bit in that question we were just talking about, because we're breaking out what issues are more important to you, and some of the questions, like that get to, well, this is an environmental issue, this is a social issue, this is a governance issue, but we're hearing more about ESG writ large across the globe. Of course, there's some organizations and companies and investors that focus just on the G or just on the E or just on the S, depending on what their mandate is, what their beliefs are. But as I said, we frame this in a risk and opportunity template of these are the things that may be outside the balance sheet and income statement that you need to know about if you're an investor, if you're an analyst. And ASG is a current acronym that kind of catches all of those.
Right. There was parsing of E versus S versus G in that very first set of slides. But if you're asking if there was parsing further to, what aspect of G, for instance, then just those slides that Matt was talking about in terms of, board accountability or climate change or human capital.
The next question, how will this study be mapped, compared and contrasted with the previous studies on ESG and investment regionally? For example, the IFC studies in BRICS countries in 2010 to 2012?
The IFC studies were of country capabilities. So it included the regulatory environment, the nature of the institutional investors. You can think of them as top-down studies of capability by jurisdictional level. This is a study of investors. I believe, therefore, it is additive to the entire body of knowledge. It's not something that has been surveyed before. There have been individual surveys around specific issues. I don't think there's been anything this broad or by an organization as respected as CFA Institute, and that looks not, again, for specific top-down predefined issues, but bottom-up, how do investors look at these issues and what do they do with it?
Our next question, board accountability was the top issue. How is that defined?
Well, I don't think we defined it beyond board accountability because, some of these we had to pare down our answer choices somewhat. We could have had 20, 30 different choices, but we had to. Board accountability gets into a lot of different areas and different questions, but it gets to governance of the board and the systems that help boards be accountable to share owners. So we had to make decisions about how narrow do we want the answers to be, how broad do we want the answers to be. And so board accountability wasn't parsed down beyond what structures and functions does a company have that make sure the board is accountable to share owners. And that can get into a lot of specific corporate governance issues. Is the board staggered? Is there a vote, majority voting? All those kind of things. But we wanted to keep it broad enough, so we had to limit the answers in some way. So that covers more the question of board and accountability writ large.
The next question, do you know if there were any significant age differences in the survey results?
No, I didn't include it here, but there's a breakdown of on the CFA Institute website of the survey respondents, and it tracks the age of our members pretty accurately.
We have a couple questions. Will the slide presentation and a replay be available? I can answer that one. Yes, the slides will be available on both CFA and IRC Institute's websites, and a replay will be available. We'll send out a link by tomorrow for everyone that was on the webinar and registered for the webinar so that you can listen to a replay and download the PowerPoint presentation. Next question. Could you elaborate, please, on tangible measures available today that you think are best helping to guide decisions? Want to try that one, Matt? Is that clear?
Again, I would ask for clarification, but I guess I can say things like, we talked about before. The amount of information that's out there now that wasn't before. Things like information, you go on the Bloomberg terminal and look at emissions by power plant, by industry, whether it's wind farms in Japan or nuclear power plants in North Carolina or coal power plants, fired power plants in the Midwest. You can find that information now where you couldn't before. Whether it's something like the SASB, breaking down, these are the half a dozen metrics that matter in the automotive industry, or drive value in the ESG space in the software industry, or whatever industry it may be. There's a lot more resources out there than there were before. I think I would leave it up to the investor to decide which ones are the most important. It's going to depend on industry. It's going to depend on philosophy and investment process. But I would just say that there's much more out there now than there was before.
Okay, we have several more questions in the queue, so I know we're getting to the top of the hour, so I'll ask a few more of these questions, and if we don't get to them all, I can send Matt and John copies of the questions, and they can respond one-on-one, because we are getting close to the top of the hour, and I don't want anyone to think that we're not getting to all your questions. The next question, how do you define ESG integration compared to best-in-class ESG research or screening?
ESG best-in-class screening is basically taking industry and defining, okay, these are the companies that do, defining what the metrics are that you think matter, and then defining which companies do those the best, and investing in those companies. Say there's the global automotive industry, and there's 10 global firms you could invest in. Breaking those out into the top 5. ESG integration. It could be using that same kind of thing, but it's more looking at broader ESG data across the board, and not just on a narrow. This is the best in class in this one this one metric or this one metric. It's more, I guess, it's more quantitative that way.
The next question, according to the study, 50% of the respondents indicate they obtain info from direct engagement with the company. What level of engagement dialogue would that be? Do you have more specifics?
Let me take that one. We have, again, for the U.S. only, and I apologize for that, but I think it's probably indicative elsewhere as well. We have done 2 studies benchmarking engagement, because engagement is one of those wonderful words that get used a lot and people don't really know what it means when you start defining it. And I will tell you that what investors mean by engagement is different, for instance, than what companies mean by engagement. Investor engagement usually extends over a period of time. It is often around a particular issue, but it is not necessarily what we would think of as activist engagement. It can be, for instance, on this issue, calling people in the ESG community often will call the appropriate person. On environmental stuff, it may be environmental issues, it may be the director of sustainability for that company. On governance, it may be the corporate secretary or the GC's office or even the investor relations officer. There is also higher level engagement that goes directly to board and C-suite. It is widely varied. It is definitely on the rise, and I suspect that to the extent this is skewed by the Americas, it is also skewed a little bit by the widespread advent of sad pay voting in the United States, around which there has been a lot of engagement. There's a, fairly lengthy report and tabular information, again available at ircinstitute.org. It was a study of engagement, and it was updated just this year. So, in some ways, engagement is self-defined, is what we have found. Companies define it differently, investors define it differently, but it's anything that is a direct contact. In general, the definition by investors tends to be what I would call more intense than what is defined by companies. And since this was an investor survey, I would assume that it fits that definition, which is a series of direct contacts, whether by phone or in person, but it does not necessarily mean engagement at the highest level the way you would in terms of a public activist campaign, where there is an attempt to influence and change corporate policy, although that's clearly would be an important subset of engagement.
And then we'll close out with one last question. Again, it looks like we have more questions than we have time for. We apologize for that. And I'll be sure to get Matt and John copies of all the questions that you all have posed, and we can follow up on those. The last question, it's interesting that AMERA respondents say they're integrating ESG, but then at a high level, these respondents don't think companies should report on sustainability with a cohesive set of indicators. Why do you think this is?
I'm not sure I heard the question right, but I think I would disagree with that. I think the surveys, we ask people, do they want companies to report on standards, and overwhelmingly they say yes. Mm-hmm. I think part of the issue there is there isn't a defined set of standards nationally or globally that folks report to. There's the GRI that's been out there a while. There's the SASB that's it's not finished yet. They haven't gone through every sector yet, and that's only going to be in the U.S., although I'm sure it would have reached beyond that. What we've seen from the survey is that people are integrating ESG analysis into their investment making process, decision making process, and that they do believe that companies should be required to report on some set of sustainability metrics, but I don't think that there isn't one that they can point to. There isn't one that exists that they can point to do that.
Just to be clear, on slide 14, 82% of EMEA agrees that public companies should be required to report. I think what there may be confusion on is those last two bars are institutional. CFA charter holders who work in institutional or private client services, and if you the colors on the little squares sometimes can be confusing, and you may think that what is EMEA is the private, but EMEA is 82%. It's the privates that are 53%.
Is that the slide, John, right there?
No, it's slide. I believe it's slide 14. Excuse me. Then go back. Hold on. It's after these.
Sorry about that.
That's okay. I went to my private deck. Hold on, keep going.
It's slide 20.
Slide 20.
Slide 20.
Thanks.
Sorry.
Let me just put that up for everyone's reference. There we go, slide 20.
Right, so as you can see, that third column, agree, the fourth column, the purple, is EMEA.
Gotcha. Well, this concludes our webinar for this morning. We thank all of you for your participation. Again, a replay of this webinar will be available along with this slide deck. Please watch for an email and we'll send you links to both of those. We thank both Matt and John for their presentation and all of you for your insightful questions. If you have any questions, please feel free to contact either Matt or John. You can see their contact information here on this page. And we thank you again and hope everyone has a wonderful rest of the day. Thank you.